Hey everyone, Jonathan Gorton here, the Industrial Insider from Leonard Commercial. I do have a special treat. A good friend of mine, Daniel Kolber from Takol Investments. Takol is a private Canadian commercial real estate and asset management company.
Thank you for the very kind introduction. Good to see you.
Let's jump right into it. What is your general overview of the industrial market?
So for clarity, we're focused primarily on small bay industrial. So for those who aren't in industrial, who might be listening to the podcast, industrial ranges from 1,000 square feet per unit on the very small end. That's about as small as I've ever seen, up to, your Amazons of the world that are 1 million plus square feet. Most of our projects, the deals we've done with you, Jonathan, Atlantic, Steels, the last couple of years, those are averaging, say, 2,500 to 3,000 square feet per unit. So, the Atlantic project was 30 units. Our Steels project is 65 units. That's kind of the math we plan. We've done some larger projects that go up to about 10,000 square feet per unit. And that's kind of where we start butting up against different investors and different owners and different types of tenants. So we like playing in that smaller space. That's kind of our sweet spot.
So all of those fall into the quote unquote small bay bucket.
Yes. Yeah. I think mid bay is more, some agent out there will you correct me if I'm wrong. It might be you, Jonathan, but I think mid bay is more 20 to 50,000 square feet, and large bay is 50 or 100 and up, something like that.
Something like that. I don't know the exact numbers, but definitely in that ballpark.
Right.
Why don't we talk about rents over the last couple of years, demand for these condo units, or these we'll refer to as the small bay market. What have you seen over the last, let's say, 2 or even 5 years since you've been doing these conversions, and what you've seen change and how you've adapted your business over the last couple of years?
Sure. As I think everyone is aware, if you've had even a fleeting glimpse of the industrial market in the GTA, rents have at least doubled, in some cases tripled or more.
Right.
In industrial. I've been with Takol, with my business partner Takashi Yamashita, for 6 years. Before that, I spent a couple of years doing some consulting in the space. And so let's say 8 years ago, when I started looking at condo conversions, rents in the east end of Toronto, where I did my first project, were $4 a foot net. Let's leave the equation because that hasn't really moved, other than on the insurance side of things. Insurance has gone up. So look, in the west end, I've seen rents go from $5. We've been mostly in Brampton and Mississauga. That's where we've done over half a dozen projects the last 5 years under the Takol real estate banner.
Yeah.
Rents have gone from $5 to $6 to asking rents now, depending on the specific location, depending on the clear height and the loading and the zoning and the street frontage. And there's all sorts of variables, as you know. Some rents are approaching $14. We have a food tenant at one of our projects on Steels. Rents are going to be well over $20.
Wow.
Now it's not really industrial, but rents have skyrocketed, right? And that's a function of supply and demand. And on the demand side, look, the GTA has been the fastest growing metropolis in North America for a bunch of years. And I think it's only going to accelerate because there's been a backlog of immigration due to COVID, lack of travel and people migrating across the planet. And that's just going to, the government is really, I think, looking to ramp up that immigration the next 2-3 years. So I think a lot of the immigration population comes here and opens a small business. It might be kitchen cabinetry, it might be import export, it might just be some warehousing. There's all sorts. There's thousands of little businesses that we see, and you see it too. And I think immigration is going to drive that. So the supply side has been immense. And in the GTA, I mean, no one built, and I don't think anyone is building right now, small bay industrial with an eye towards leasing it rather than doing condo. The math just hasn't worked since I think the early 80s to build small bay industrial and lease it up. The economic returns have not been there.
Right.
So, with that lack of growth, that lack of new supply for 30 years, combined with this huge amount of demand, which has been exacerbated or amplified anyways by COVID and last mile distribution and people needing more storage space. The supply and demand equation is kind of broken. So there's, whenever the demand really outweighs the supply, and there's still no economic grounds to build more supply other than to condo directly, the rents just go through the roof.
How has your business really changed over the last 2 to 3 years with rental rates really skyrocketing, high demand for these types of units? Like, what have you changed, or are you just paying more for product? Like, is it as easy as that, or as simple as that? What have you guys changed your business plan or adapted? I know it's hard to get your hands on product. Like, what are the type of things that you've done that really sets you apart from other guys in the market, or managed to grow your business over the last couple of years?
I'd be happy to answer that question. It's going to take me a couple of minutes. So first, on the acquisition side,
yeah,
you have to pay a lot more for projects. If I go back 8 years ago to when I did my first condo conversion, I think we bought that project for $70 a foot and resold condos at $120 a foot.
Right.
And the next project we bought, I think it was $87 a foot, and then sold condos at $150. And everything, that purchase price has kept going up, and our resale price has kept going up. Obviously, we need to have a significant margin to do what we do with condo conversion, which is a lot of legal work, a lot of survey work, a lot of capital work. We do new roofs, new parking lots. We renovate interiors. We redo some landscaping, sidewalks. There's a whole smear of capital that goes into a project to make it sellable and to renew it, right? Because we're buying 40 or 50-year-old buildings built in the 70s or 80s. So on the acquisition side, yes, we've had to pay a lot more for product, but as rents have kept going up, implied purchase cap rate. So as rents have gone up, our cap rates on purchase, have largely stayed the same. We try and look at our condo projects, Jonathan, when we buy them, we look at our fallback plan. What if for some reason the condo conversion plan doesn't work out here? The sales don't happen, or there's pushback from the municipality or some sort of authority, TRCA,
right,
the Toronto Regional Conservation Authority. For whatever reason, we look at, okay, if we had to just own this a year after purchase or 2 years after purchase, are we and our investment partners still whole in terms of the rents coming in? So it's become harder to buy. I think there's more people looking at doing condo conversion. So even though we're very well capitalized, we've got all sorts of different partners ranging from private equity funds to, family offices, or high net worth individuals, and ourselves. We've got money in every deal we do. Even though we're well capitalized, there's other people out there, of course, who are seeing condo conversion as an opportunity and trying to get into the space. And just because industrial's become much hotter as well, there's just more competition for people wanting to own industrial. They see the demand, they see rents going up. So lots of people are looking at both small bay and large bay industrial right now, as you're well aware. That's your bread and butter. Well, in terms of acquisition or I guess post-acquisition and going through a project from start to finish, there's a whole laundry list of things that you have to do. And all of those things seem to have gone up in cost the last 5 years. So the price of roofs, has skyrocketed. I think we used to do roofs for $6 a foot. Now we're 10, $11 a foot, it seems, for a proper roof, not a single ply EPDM kind of roof, but a proper built up roof, multi-ply with a 10 or 20 year warranty. Cost of asphalt, which is, has a petroleum base, has gone up, even though oil went down. It just seems like costs have gone up across the board. So, we have a pretty good grasp on our costs in terms of who our team is externally, the surveyors we use, the planning consultants we use, the engineers we use. But the material cost certainly has gone up.
So I guess that kind of leads into my next question. How has inflation really affected you and the market in general?
I think, I think you and I've had this conversation before, like, when does the party end? How much can people really afford to pay in rent, or how much can they afford to pay on the small bay industrial side for the purchase of condo? And I think in many ways, or in some ways, it's easier for some of our customers, our condo buyers, and those might be existing tenants in a project we are converting. It might be people coming in from outside the project to buy a condo. In many ways, it's easier for people to get their head wrapped around paying top dollar to own something than to see their rent having gone up so much the last bunch of years and forecasting it to just keep going up in future. So the inflation, when does the party end? How much can an industrial tenant afford to pay in rent? Industrial is different than, say, retail. I worked in retail the first 8 years of my career, plazas and malls, street front retail. In malls and plazas, a lot of retail landlords do collect sales data. In many cases, they collect percentage rent. They collect as rent a percentage of that tenant's sales as part of the rent equation.
Right.
A lot of landlords have had to really look at that hard as a bigger part of their income during COVID to try and help tenants along. But so in retail, there's what's called a GROC ratio, gross rental occupancy cost, which is a percentage of a tenant's sales as measured by how much they pay in gross rent. So net rent plus MI or CAM and tax. So retail knows that an anchor can pay, I forget the numbers, and they've probably changed 2 to 3% of their sales as ratio, and some small commercial rental retail units can pay maybe 14 or 15% or 20%. If you're a Yorkdale and you've got really high margin tenants, Tiffany or whatever, those are different. We don't have that in industrial. I don't know what any of my tenants do in sales. I think some landlords ask when they sign a lease with a new tenant to see their financials, and that might give them a bit of a sense as to how viable the tenant is paying X amount of rent. But we don't have that at all. So, the only thing I have to gauge the market with, or one of the tools I have to gauge the viability of the market with, Jonathan, is just looking at occupancy rates. And, the GTA, I mean, vacancy rents are what, 1%, give or take, which is really just frictional vacancy. It's not like 10%, which is an economic problem. 1% is really just people moving, they're upsizing, they're downsizing, there's some downtime to get something leased when someone's lease expires. It's that kind of thing. That's what we're seeing, at least in any decent location.
Well, I guess we'll wrap things up. I want to say thank you for joining me on the Industrial Insider. If you have any questions, you can email me at jonathan@leonard.com or give me a call at 416-471-0904. And thanks for tuning in for the Industrial Insider. Have a great day.